The better your credit score, the worse your interest rate will be? I'll explain. You might have seen some other mortgage professionals show you this exact same chart, and basically what this is what's called loan level price adjustments. Now, I know none of you care what that actually means, but basically what this means is that based on your credit score and based on your down payment, how much are we adding or deducting from your interest rate? So if you'll take a look at this chart, you'll see from about the 780 range to about 700, and especially in the middle towards like 70% and 95% loan to value, which means you're putting somewhere between 5% to about 25% down as a down payment. Notice all of that red. That means that your mortgage is now going to cost you more on an interest rate than it did a year ago this exact same time. Now, why are they doing this? The companies that oversee the mortgage market in the United States when it comes to like our regular type of loans, they are basically making affordability their number one concern going into the future, which means they want people who have less of a down payment as well as maybe less than perfect credit to be able to afford a home, which means that they're going to give them a little bit more of a break when it comes to their interest rate. Now, I've heard some other lenders call this like a Robin Hood style of, redistribution. However, it's important to note that your rate is not significantly higher than say what's standard in the market. You just don't have as big of a benefit as you used to when you're going to purchase a home now. So, the difference between someone who had a 760 credit score and a 640 in the past might have been a 0.5%. 0.75%. And now that gap has been reduced. So it's not necessarily that you're getting this huge outrageous interest rate to pay for someone else. Basically, you just don't get as much of a benefit now for having a higher credit score when you go to apply for a mortgage. Follow for everything mortgage.